Welcome to PhillipCapital Weekly Market Watch. I'm Me Ling for Phillip Investor Center. In this video, we'll talk about the fundamental analysis of the current economy and the technical analysis of the major indexes. Today, we'll discuss about the recent economy data and the charting analysis of US and Singapore market. Recently, Singapore investors had been focusing on the news of the US renewing Iran sanctions, which has caused oil price to spike above $70. The US-China trade war tension, as well as the surprising win of the Malaysia's opposition party in this year's election. News of the threat from North Korea to cancel and the landmark summit in Singapore has also added volatility to the market last week. On top of it all, the fear of history repeating itself has also taken root in many investors' mind. Many worry the repeat of the crisis in 1998 and 2008 as we come to the middle of 2018. However, long-term investors should focus on the fundamental of our economy instead of focusing on the short-term market turbulences. Is the fundamentals of our economy today really stronger than in 2008? Let us examine the major economy data together. As we can see, US economy grew at annual growth rate of 2.3% or 2.9% year-on-year in 2018 first quarter, down from a 2.9% in Q4 2017, but higher than the expected growth rate of 2%. The US Federal Reserve in their March FOMC meeting had raised their forecast for 2018 GDP growth from 2.5% to 2.7% and increased the 2019 expectations from 2.1 to 2.4%. However, growth is likely to cool after, with the 2020 forecast holding at 2%. On the other hand, the chart here shows US GDP annual growth rate from 2007 to 2018. The GDP annual growth rate in 2007 Q1 was below 2% and had been in the downtrend for many quarters before it declined to negative for Q3 and Q4. However, today's US GDP has stayed above 2% for 4 consecutive quarters and is expected to continue the same trend powered by a strengthening job market combined with Trump's tax cut. The US unemployment rate for April 2018 dropped to near a 17.5-year low of 3.9%. This means the labor market is at close to full employment and should be able to continue supporting US domestic consumption and increase demand for goods imported globally. 10 years ago, US unemployment rate stayed mainly above 5% and reached a high of above 8% at the end of the year. Today's unemployment rate has stayed steadily near 4% and is following a downward trend since 2010. Inflation is another key factor Federal Reserve looks at for rate hike decisions. Annual inflation rate in the US edged up to 2.5% in April from 2.4% in March, in line with market expectations. It is the highest rate since February 2017. However, core inflation was flat at 2.1%. The chart shows that inflation in 2008 stayed mainly above 4% before falling to near zero after the rate was cut to zero in the end of the year. Inflation today has been in an uptrend since 2015 and may continue to rise amid higher oil prices, but still fall way below the 4 to 5% mark a decade ago. Back at homeland, the economy of Singapore grew 4.3% year-on-year in the first quarter of 2018, or at an annualized rate of 1.4%, matching market expectations. It was the second fastest growth rate in the 13 quarters. Manufacturing, wholesale, and retail trade grew faster, suggesting substantial momentum in demand for goods and services, while construction continued to contract. Similar to the US, Singapore GDP annual growth rate data were in the downtrend 10 years ago. Today, economic growth in Singapore has moderated but continued to slowly trend upwards in recent quarters. Singapore's unemployment rate in the first quarter was 2%, down from 2.1% in December last year. This shows that the labour market continues to strengthen this year. Back in 2008, unemployment rate was rising throughout the year and reached above 3% in early 2009. Today, Singapore's labour market is considered close to full employment, with unemployment rate hovering around 2% in recent years. In summary, the current indicators shows that our economy is growing healthily in 2018 and thus unlikely to repeat the history of 2008 financial crisis in this year. On a technical perspective, we saw that the STI is well supported at 3350 levels during the two sell-off in early February and late March. Market has retreated after hitting decade high of 3641 in early May. Profit taking and dividend payment has contributed to the recent decline. This chart shows that stochastic oscillator has reached below 20%, which signals an oversold conditions. STI is expected to continue the uptrend with a bullish engulfing candle displays at today's chart. Similarly, Nasdaq Composite was also well supported at 6,800 level in recent sell-off. However, stochastic shows that Nasdaq is currently trading at an overbought positions, could see some profit taking before trending up the next resistance level of 7,500. Nonetheless, the positive news announced on Sunday on the agreement of US and China to put the tariffs on hold while working on a framework might be able to drive the market further upwards. With this, we have come to the end of this week's Market Watch. Subscribe to PhillipCapital YouTube channel and visit our website for more information. Thank you.